Welcome, everybody. This is our maiden voyage of a podcast. I'm Jared Johnson with Union Hedge Funds, joined by the one and only Jeff Kohler. Good to have you,
So,
Jeff.
Jared, how you doing?
Good, man. We've been talking about doing a podcast for a little while. I'm pretty excited that we get to talk about some markets. We'll obviously focus our time and energy on stock markets. We'll talk about some cool macro stuff. You always have some interesting takes on the market, so I'm going to enjoy it, and I hope everyone else enjoys it. I think there's some good nuggets to be taken from the discussion today. But Jeff, for all those that are seeing you, hearing you for the first time, give us a little intro. Give us a little bit about yourself.
Yeah, sure, no problem. Been in financial markets since as long as I can remember. Coming out of high school, that was back in the late '90s, right? So, took a job with Morgan Stanley. Got in there to learn the market, and that was 1998. So I've been doing this for like 25 years. That led to working for different brokerage houses, starting my own advisory, working on my own hedge fund, and yeah, so I've got extensive market experience, but I have a different way, different view of looking at the markets. I've interacted with different hedge funds and different guys, and learned a lot. Learned a lot about how the behavioral side of things work, mixed in with the day-to-day nuance of financial markets. I always viewed it as kind of like you're staring at a code of the matrix all day long, and you're looking for that one little code that just doesn't look quite right that particular day as to what's changing, what's evolving. And so I think if we bring that kind of analysis and discussion to the table, it's a little more eye-opening than a lot of the content that you find out there. So I'm pretty excited. We've got some good chemistry together talking stocks, so I'm excited to do it.
For sure, for sure. I think it's going to be awesome. I know, for example, typically in the past when you and I have discussed stocks and trading ideas and so on, if it's like on the front page of, say, I don't know, Market Watch, for example, or maybe whatever other site, you're going to be on like the far extreme side of that. Safe to say?
100%. The way I view Wall Street is it's kind of like the Titanic. Everybody rushes to one side of the boat, and then you want to be one of those first guys to start working to the other end before it capsizes. So it's and that's to me what market cycles are all about, is understanding the pendulum effect. And we can, I think, break that down into like kind of day-to-day discussions and where you can see that. And what normally for the retail investor won't feel most comfortable to do is usually the smartest thing that you can be doing at any given time, because it's not what the crowd and the herd is doing. And that's
Yeah.
where most people get hurt, is getting in too late into that effect.
So that brings up, like, I would say, two questions immediately, right? So you have some of, I probably the Wall Street idea is if you're too early, you feel a lot of pain, right? You and I know hedge funds and big investment funds and so on. As weird as it sounds, like higher prices. They don't like to get too good of a deal, right? If a stock was trading at 150 bucks a share, it's down to $10 a share. They're not touching it, right? They need it to be maybe at 50 bucks a share before they jump in on that. So what are your thoughts about buying that used to be $150 stock, now $8? How do you approach getting into a stock like that and not being stuck in something that's going to be $8 and $10 for the next 2 years before it works its way back up to, say, $100?
That's one thing that I'll never quite understand is people view trading entirely different than you would be shopping for a car, or shopping for, you know what I mean? It's like, I'm going to wait until that car is 30% higher in price, and it's at its all-time high before I go and buy it. It's just never really quite resonated with me. But at the same time, you're right. If you, I think I think crowd participation ruins everything, right? And so when everybody starts hoarding into an idea, I look at it this way: like, in a perfect world, like, the appreciation of markets and just world economics should be on a slow, steady 45-degree angle over time, right? The value of technology and innovation, and businesses being around longer, getting leaner, getting smarter, value should increase steadily over time. But what happens is we get too excited about an idea, or we get too down about an idea, and that causes these massive peaks and troughs in pricing. So, to me, it's all about finding when something is completely mispriced. Like today, you see Boyd Gaming wants to put in an offer for Penn Gaming, because Penn Gaming trades into the teens when last year it traded for like 150 bucks a share. Like there comes a price where, man, this is too sweet that we're just going to have to buy the whole damn company, because it's just, it's ridiculous that this stock would trade at this value. But that's where like sentiment and behavior and all those things come into play. And that's where I feel like I got a much better, everything really started to kind of click, that aha moment for me, when you really put into, when you appreciate how crowds, rev things up and push things down. And what you say is right. You want to be early, you don't want to be too early. Um, but you want to be kind of right on time. And I think that's why, paying attention to trends of what bigger hedge funds are doing. And, there's a reason that retail investors, when you say an idea, it makes them want to throw up. They hate it so bad, but that's usually a good sign that you'll find a good deal there. You'll probably be selling it back to them 100 times more expensive, right?
Yeah.
So
No, I,
that's my
I, I think
thoughts.
that's definitely an interesting point. There's we approach the stock market very opposite than we do buying anything else. And so, but yeah, that stock market psychology, I think once you start digging into people's pockets, they get very irrational and sensitive, right? Is my retirement? I had a good buddy, bless his heart, that decided that 2020 around March or April was a great time to just close everything else out and be able to buy at a lower price. And of course, he got out at the exact bottom and then missed out on everything. And so, there's that emotional response that people like to have to the market that really screws everything up. So on that front, we've been looking at a pretty weird market the last, I don't know, year and a half, right? 2023, we had a handful of stocks do all the movement, and there was a little bit of catch up towards the end of the year. We've seen more catch up this year. I mean, is it just me, or do you feel like there's kind of a ton of value out there that's super underappreciated?
I will beat this drum every single moment that I'm asked, but half of the market is ridiculously cheap, and a good portion of it, maybe 20% or so, is really expensive. And I look at this as like, most people that manage hedge funds or work on Wall Street, their average length of experience is about 8 years, right? So they sit down and they start learning about the current environment, but they don't pay attention to past cycles or past conditions. Like, a lot of these younger guys that are getting into bitcoins and stuff like that, and don't realize that, like, the markets have undergone one of the most crazy shifts in what we've done in interest rates in like the last 100 years, dating all the way back to the problems that we had during the financial collapse, right? I mean, we created products that created losses on the consumer that you would not have even dreamed of, right? And the only button that they could heal over time was to take interest rates and put them to zero. And that had an effect on a lot of things, right? If you don't get any interest on your money, there's absolutely zero reason to put it into a bank. If yield is non-existent, then we saw a big shift towards startup businesses, unicorns, kind of long duration assets, where, hey, let's throw money at this tech company and hopefully it grows, because it's better than getting 0.25% in a bond, right? And so it forced money to get into the market and get in and to spend. And then, we get into COVID and we shut down the economy and we start stimulating. And then all of a sudden, we got to reintroduce interest rates to cool down this red hot economy. And now all of a sudden, we're incentivizing people to put money in the bank, to slow down their spending, to not go purchase a home, maybe wait a little bit longer, basically temper the economy by this bazooka of higher interest rates in such a short period of time. And I don't think as many people saw that coming as should have, because they haven't been through a cycle like this before. And really, the Fed's playbook of 0% interest rates was kind of new for us. It's not a new concept in world economics, but it was new for us. And so that immediately started a ripple effect that really just absolutely destroyed the tech sector, and it brought back the emergence of interest and value stocks. And then we went through a shift, like you said, over the last year and a half or so, where tech stocks came roaring back. and a lot of the value type oriented things just kind of leveled off after a really red hot run from 2020 to about Q1 Q2 of 22. So
So
I think we're dealing with a little bit of that kind of consolidating a bit.
so that brings two thoughts to mind. Number one, these tech stocks came cruising back. They had tons of money on the sidelines, right? I mean, we always hear about Apple sitting on 150 billion, Microsoft, 150, 200 billion in cash. These companies have tons of money. So high interest rates, low interest rates, they're rocking and rolling, right? Do you think
They're
that?
inflation resilient, right? Like whether you have inflation or you don't, those companies they're not going to be bothered by it.
Yeah, they just kind of can roll through any of it. They're good to go for the foreseeable future. So what do you think the effect as we kind of went from this zero interest rates for a long time, all these unicorns came out of it, money was cheap, companies were, I mean there was IPOs on top of IPOs, to money's expensive, why not take zero risk and make 5% and just let it sit and where do you see that going? Do you see money continuing to kind of flow out of anything with risk and just into a hey 5%, no problem, let's ride it out till further notice?
So I mean, that's definitely changed the mood of markets, right? Because when interest rates were at zero, you had no alternative but either to put it in stocks and watch long duration assets just run and run and run endlessly. I mean, we basically from 2009 bottom have had one of the most remarkable bull markets of all time. Now that you reintroduce interest rates to where you can get a guaranteed 5%, well, that kind of changes people's thinking of rather, I'm going to go risk however much capital depreciation to grab a dividend when I can just put it into a treasury and or bond and then be fine. Everybody's rethought that a little bit. And now the complicated part about this, which is making it hard for people to really understand the different pulses that are at war in the markets right now, is there's the interest rate thing, yes, right. And so I think it was 2019 when we had about 100 companies come to market that year, and collectively they all lost like billions of dollars.
Sure, I
Like
remember.
the private equity bubble sold all of this trash onto public markets, and people just ate it up. And I'm sitting here thinking, okay, yeah, Uber's is cool. They burn through money like crazy. These Pelotons, okay, you go buy a $2,000 bike and you pay all this money. When are they ever going to show a profit for all this shit stuff that they're building? Whatever. Like we were just getting bombarded with just really low quality. One day we're going to see a profit. The best way I ever heard it explained is we had a bunch of companies that were selling $1 bills for 80 cents. And the thought was is that if they could get their user growth up enough, then maybe when they got, tens of thousands of users, they would use that crowd to like maybe flip a new product onto them or something to put them back into the plus column. But they never got that opportunity because now with inflation and prices going up, if you're a company that needs to get access to funds, you need to loan, or shoot, if you're Elon Musk and you need to build a car and that car is 30 to 40% more expensive, that's going to cut into your profit margins. Profit margins, which were thin at best, are gone. Now you're in the loss column. And so it's easy to sift through a lot of that trash right now. Like I think you can look at people have been pretty adamant about wanting quality big cap tech as opposed to, a Peloton or a Zoom is still sitting at 20, 20, 21, 22 lows, right? So I think the narrowness of the market is a product of, well, right now, we're not going to try to figure out who's going to survive. We're just going to go with what we know. And I think that's been just kind of an overcrowded, overpopular train of thought. And that's why we get this, you look at a chart of the NASDAQ and then you look at a chart of the Dow or the Russell, and they couldn't look any more different from one another. And that's a rare thing to happen.
Yeah, no, for sure. So when you look at some of these sectors out there, I mean, does anything jumping out at you that you think, geez, great companies, financials are great, their stock prices are at 2, 3, 5 year lows. I mean, there's plenty that are at big lows that may not come off those levels for a long time, but there's plenty that probably will. I mean, is there any area in particular you're loving?
So this is where like the timing of this conversation is interesting because I feel the other pulse of the market that people can't quite figure out is the part that's scared of a recession. Okay. So let's say, and right now a US recession is considered the outlier risk. It's considered the black swan event. When last year it was priced as a pretty high probability, right?
Yeah.
I mean, if you look at last year, they thought, okay, this bazooka move in interest rates is going to trigger a U.S. recession, right? If you look at Google Trends and the word recession last year, I don't think anybody's Googled, hey, what the heck is a recession, more than they did in 2023, right? And if you look at a stock that's sensitive to recessions, like any energy stocks or material producers like Alcoa gave back, I mean, well, from like $100 per share into the 20s, right? I mean, just got absolutely smoked last year. Because why you want to own a builder or a construction component, a material component, when you don't know if we're going to be in a recession or not? Now, so with that said, I think you kind of have to look at this market like as a lot of things are mispriced because there's still that concern that a recession is imminent. And if you look at retail stocks in that way, or anything consumer related, everything is at a significant discount, right? And retail's kind of a funny topic, anyways, because you got Abercrombie and Fitch. They make cargo pants, and they can't, no price too high. And then you go look at something like Kohl's, and I'm praying Kohl's goes to zero because what do you get, like coupons in the mail and you walk out with free stuff? I don't know.
Retail is a funny space for sure. I think there's definitely a lot to be said about that. I was just looking at Target, and I was thinking, what is going on with these guys? They're the most overpriced, underpriced stock probably out there. But
yeah, and if you look at anything like resembling a Target or a Home Depot or even like a FedEx, these consumer plays, they're down on the year, and the market looks great. But like, why is the market going without these guys? And that's just kind of like there's an underlying concern. It's a little bit less than it was last year, but like if somebody says the R word on Wall Street, man, there's certain stocks that they won't touch.
It last year was pretty funny. I remember, even like, I think there's some smart hedge funders out there. There's some smart big players, and everybody was like, they were even assigning a percentage. We think there's an 80% chance of recession. I'm like, where are these numbers coming from? Where the sun don't shine? Like, what is this? I don't even know what this is. But
I call those guys shepherds.
For sure. So here is the big question then, and this is the one everyone gets asked, right? And everyone is thinking and wondering. So we got all these big tech stocks, right? I mean, NVDA, what has it been, 3 or 4 days? And NVIDIA, I don't even like that word. It makes me ill to say it. But NVIDIA, the crazy stock that it is now the most valuable company on the planet, right? They just passed Microsoft and Apple, and they're just going nuts, right? So the question is, like, with these big players, right, are kind of top, I don't know, 5, we'll call it. We could call it the top 3, Apple, Microsoft, NVIDIA, right? If these guys start to correct, does it give opportunity to the lower stocks, or does it drag everybody down?
So do this, like, you pull up a chart. Let's pull up a year-to-date chart of NVIDIA, right? And I actually think that we're having this conversation on a day like today is really, really important, because I think today is one of those days. Like, in my opinion, every year there's probably about a half dozen days that like set off trends, and I'm pretty sure today was one of them based on what I saw. But if you notice, like, yeah, when you zoom in on Nvidia, I mean, look at how it traded. Look, you see that flat spot in the year where it was just kind of had leveled off.
Yeah.
And recently it's been trending. So now, if you were to take a chart of, let's say, like a Freeport-McMoRan or an Alcoa, you'll notice that during those periods when Nvidia was flat is when Freeport-McMoRan and Alcoa and these other stocks moved the most. And I was doing this analysis with Microsoft earlier today. So that chart right there, Freeport-McMoRan, shows kind of in a range, kind of at the lower end, right? And if you were to look at a chart of Microsoft, that chart of Microsoft looks pretty much like, in terms of its position, looks kind of like an upside down version of Freeport McMoran. So what I found out this year, there is kind of an inverse relationship to where when these Magnificent Seven stocks are trending, everything else cools off. And the moment those Magnificent Seven cool off, that's where the market starts to see some real breadth expansion. This last time this happened was in January. I don't know if you watched January. The tech stocks traded down for like the first week, for first 3, 4, 5 days, and then they took off. And everything else didn't bottom until later in the month, right? And so since then, there's been kind of this interesting inverse correlation where, when Microsoft has been trending or NVIDIA has been trending, most things have leveled. Like, and a classic example would be to compare the IWM, which is kind of coiled up over the last few months, or the NYSE, or the Dow, or the RLV, which is the value index. All of those things are kind of sporting kind of a sideways consolidation pattern. But you look at the S&P and the NQ, the NASDAQ, and those things have been trending. And so the last time I saw a year like this was in 2014, very, very, very similar to 2014. And it was the year after 2013, which is a really, really directional year. But it was where the market had kind of this inverse push-pull relationship with one another, where it was like the beginning of the year and a lot of the high-profile growth stocks like cybersecurity and solar were a big thing back then. And in the first couple of years, the first couple of months, excuse me, they got crushed, and stocks like Apple and everything just went on without them. So I see a little bit of that going on right now. And so why I think that's important is you look at Microsoft, which has curled down the last 2 days. You look at Apple, which has kind of, come in a couple days. NVIDIA had a big, a really volatile day at a point of strength. That generally means that prices are at minimum going to level off a little bit. And you'll notice that in that last 2 day sequence, energy stocks have turned up for the last 2 days. Alcoa has turned up for the last few days. Freeport McMoran has turned up for the last couple of days. Disney's turned up for the last couple of days. It's like when the money and the focus kind of aims to pause at these popular stocks, it allows everything else to get a bid.
So what do you think? Like, so let's just take NVIDIA here, for example. NVIDIA had a pretty ended up the day. Is that right?
Yeah, started gapped up +5 and then sold off all day long.
Sold off all day long and ended down about 3.5% for the day, right?
Right.
So
big outside day reversal, right?
Yeah, huge reversal candle on that. I mean, that's some painful selling on the day for sure, right there. But do you think that there is like a tipping point, right? So let's say NVIDIA corrects 10%, 15%, 20%. You think if we start to see like, okay, NVIDIA is down 15%, people are starting to worry? Or is that still gonna, do you see the flow still going to those way undervalued performing stocks?
Here's how something like that happens, right? So this stock with all the noise and the excitement about artificial intelligence and how it's going to reshape the world, it's only gone towards a handful of big cap tech stocks, right? And so NVIDIA is in the best position to take advantage to sell the hardware. Like they're in a primo spot. And this is not a conversation about anything that they're inadequate or not, overpriced or whatnot. But how these things do happen is this is where NVIDIA starts to level off. And now they wait for price and expectations to kind of intertwine. What happens on a stock like this is it'll probably be pretty similar to we saw about a quarter or so ago when it levels off. And you'll kind of want to wait and see from the CEO, hey, are things still looking good and all that? Expectations are pretty high. And so what happens, the only time you have to worry about a situation like this is if prices are pretty elevated and they're waiting and you hear something bad. The worst place to be, when there's a fire is in a really, really crowded room with only one small door, right? The door gets really, really small in a situation like that. So I don't see anything here in the near term that says this is a risk. I don't. I don't feel like it's an opportunity. But the only way you get hurt in something like that is you get caught, in a in a vulnerable position. See, what I've learned over time is like stocks don't ruin trends. Stocks don't do bad things. It's people act irrationally, or the crowd is what ruins stocks, you know? So if you get a big push or a ramp into earnings and somebody gaps down, well, then that starts usually what we call a pain trade, and that ends up, hurting a lot of people. But I don't, to me, I think something like this levels off, and you probably wouldn't see something until earnings that maybe catches people upside down. And that's the only time that you're at risk of a really nasty sell-off, is when everybody's holding or everybody buys because they want to be a part of something and it doesn't work out. And then everybody has to start getting out one by one. That's the only time that situations like this end badly.
Yeah, yeah. Well, I mean, I feel like this is such a good time to be having this conversation because
100%.
we're in an election year. We're in summer where things are probably going to be a little bit chill for a little while. So there's time to kind of plan out your next move. We're at a time where interest rates are up. The Fed has kind of changed their narrative from the end of last year, beginning of this year. Cuts, 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 no cuts at all. So I think there's a lot of things going. And I definitely want to start our next episode with a pain trade discussion, because I think there's a lot to be said on that. And I think we have a lot of opportunity there. So I've loved this. I think this is a great discussion. I hope everyone can take something from, you've been in the markets for 25 years, probably, at least.
Yep.
And I've been at it for 20 years. And the point you bring up of, we kind of just see the same thing over and over again. People rush from one side to the next. We can never get, it's funny, in elementary school, we knew you had to have a similar size person on each end of the teeter-totter. And the stock market,
teeter-totter doesn't lift when there's 4 people on one side.
You can't have the bully on one side and the shrimp on the other. It's not going to work out so good. And so somehow the stock markets seem to think that works. And so I think there's a good discussion to be had about the upcoming pain trade, how to prepare ourselves for, what everyone is most afraid of and most excited about, election year, all that. So this is awesome. Tell everybody where they can kind of keep an eye on everything that you're doing, what you're doing, Twitter, anything. How do you want to be looked at?
So I haven't been the most active tweeter, which, I'm on Twitter so I can kind of watch not what people say, but when they say it and what the message is, whether they're up or down. I should probably get into that a little bit more, but I think what we'll probably end up doing is you and I might start just putting out our own content, and then just kind of use under our brand here to so I'll probably be a little bit more active here moving forward, but this is kind of a good opportunity for me to start a newer narrative.
Yeah, absolutely. And everybody, you can comment below this video, you can reply to emails, to wherever you see this posted, and Jeff and I will be watching. We'll get back to you. We have some super good discussions coming up, and I think it's going to be exciting. And again, I think it's a great time to be diving into some of this stuff. So awesome stuff, Jeff. Thanks for all your good thoughts, input, and thanks everybody for watching. Questions, comments, hit us up. We have many, many more episodes coming, so keep an eye out wherever you watch and listen to your podcast. Thanks, everybody.